Welcome back. In this quick video, I'm going to explain your mortgage payment. A mortgage payment has several components. The first is your principal and interest. So principal and interest is the starting balance of your loan amortized over the loan term, most often 30 years. So in this case, if you go to a loan calculator, you would plug in $400,000 as your starting amount, 6% as the annual interest rate, 30 years as the term. That will get you roughly $2,400. The next component is mortgage insurance. You pay mortgage insurance if your loan amount is greater than 80% loan to value. The loan to value is the loan amount divided by the lesser of the purchase price or the appraised value. Again, you will be paying mortgage insurance if the loan amount is greater than 80% loan to value. The mortgage insurance does go down as you get closer to 80%. If you're at 95% loan to value, mortgage insurance is highest. And as you get closer to 80% loan to value, it's going to be lower. And if you're below 80% loan to value, you won't have mortgage insurance at all. The next element is property tax. Property tax is paid through your mortgage, and I'm using a figure of 1% times the original property price. We're calling this $400,000, and then you're going to divide by 12, and that's going to give us a rough estimate of our property tax. If you want to know the actual property tax, look at the annual tax bill for the property and then divide that annual or semi-annual number to get a monthly figure. Some states do not have property tax, so if you live in a state where you don't have property tax, you don't have to worry about that one. Next, homeowners insurance. This covers your house if something happens to it, like a fire or damage. Homeowners insurance. This premium varies. I'm using a rough figure of $200 a month. You could call 5 insurance companies and get 5 very different numbers. So when it does come time to buy a house, please get a couple different quotes so that you can see which one's right for you. Before we add them up, we have principal and interest, which is a result of taking that loan amount. Using a loan calculator, you're going to plug in the original loan amount, plug in the interest rate and a term of 30 years. That's the most typical. And then you're going to get your principal and interest payment. Mortgage insurance, you're going to pay mortgage insurance if your mortgage is greater than 80% loan to value. Property tax, I'm using an estimate of 1% per year and dividing by 12 for a monthly figure. And then homeowners insurance, I'm using a monthly figure of $200. This gives you a total of $3,100 a month, a PIT payment, principal, interest, taxes, and insurance of $3,100 a month. So when you see your monthly mortgage payment, it is going to include principal, interest, mortgage insurance, property tax, and homeowners insurance. Important to understand, these 2 items, property tax and mortgage insurance, are part of an escrow account. They keep this money and they pay it on your behalf. When you get that property tax bill every year and you pay that in your mortgage payment, that means the lender's going to send that money to your tax assessor on your behalf. You don't have to worry about paying it. That's a quick explanation of what is included in your monthly mortgage payment. In this scenario, we have a $400,000 loan. Your monthly mortgage payment at 6% would be about $3,100 because it includes all of these other elements. Please don't forget to subscribe so that you get alerted for our next video. Have a great weekend.